Well, good morning, John. It's always good to see you. We're recording this on Wednesday morning, and I thought I'd start by just noticing some overnight developments on the international front. Iran launched something like 180 ballistic missiles into Israel. Now, not a whole lot of damage was done in Israel, but we can predict that there will be a strong response. And that was somewhat reflected in markets. We saw share markets selling off slightly, the US dollar, gold, and oil all rising as a result of that. I must say that I think there's a rising chance, not yet a probability, but a rising chance that Israel might decide to go after Iran's nuclear facilities or their oil fields. And I would still put those risks at kind of low probability risks, maybe 10, 15%. But if they were to happen, they could have material consequences and be very adverse for markets. Any thoughts on that topic, John, before we launch into some of our other agenda items?
Look, not a lot to say. I think the risk is heightened. I do believe that covertly America does communicate with Iran as it does with Russia, and consequences of attacks. I think we know that there's been a very stern warning to Russia regarding nuclear weapons and their use. And I think there'll be a very similar sort of message going to Iran. So I take your point. I think we're going to have a heightened level of escalation without going over probably a trigger point. It's almost the rules of engagement, which is what goes on in the world today. Hopefully it doesn't go past that point, but we all watch and pray end soon.
Yeah, I think the timing is interesting because there's only 5 weeks to go before the presidential election. And I'm sure that Israel perceives Biden as a lame duck, and that they can kind of possibly push through an American response that they might not get out of Trump, but or Kamala Harris. But anyway, so we might see increased volatility between now and the 4th of November. John, one of the big moves in markets over the last week was the somewhat surprising Chinese stimulus package, which included fiscal and monetary elements. And the market response was quite remarkable. We had the Shanghai index up 12% in the space of a week, and commodity prices jumped. And it really seems to have shifted the narrative somewhat. Is this a turning point for China, or are you still feel that they've got serious problems to deal with?
Well, look, there are problems in the apparent in terms of housing starts and housing approvals. So that was the big issue, and lack of confidence in the household sector caused by declining house prices. So that's well known in economics. You know, the wealth effect has a knock-on effect to consumption and then slows your economy. So my reading of what they've done, it's long overdue. I think they were trying to resist doing what they've done for as long as possible. They certainly have put the double barrels into the monetary part of the policy. They've really, lowering lending rates to banks through their central bank, and restricting or lowering credit standards somewhat, and deposit standards in the housing market, second purchases for homes. So quite a lot of stimulation directed at that housing market. I think I've been saying this, that the housing market was so far down in China you would reach a natural bottom, this is going to ensure that that bottom is reached very quickly and that there will be some recovery. It is a transition point. I think we've gone through an inflection point. Whether it has all the desired outcomes, time will tell. But markets were very oversold, Paul. I remember sending you a message. We saw one day the Hong Kong market was up 4% and the Japanese market was down 4%. So the extent of hedge fund activity and pair trading, I comment on this regularly, is extensive. And so a lot of these unwinding of trades cause massive gyrations in stock prices and index prices. Very hard to predict and very unfair to be judged, if you're on the wrong side of that or you haven't predicted something which has come out of left field. So I think it's all positive. I think it's positive for our region, positive for Australia, that sort of stimulation. We're seeing the reaction of the stock market, which reached a recent high, driven by resources rather than banks.
Yeah, just to add to that, so resources were the best performing sector for the month of September. I was just busy drafting the monthly report. The sector was up 14%. Commodities, the ASX resources sector, which is pretty staggering bounce back. And over the September quarter, the ASX pretty creditable performance for a quarter. So we're looking good. Unfortunately, the valuations are getting richer and richer. At the moment, we're on a forward PE of 18.9.
Look, I think it's worth saying this, Paul. I think we've talked a lot about where the big investors are investing money, and now the Australian dollar is stirring up, and it's clearly off the bottom. And the revaluation of the Australian dollar was occurring, and then we've got the Chinese stimulation. If you're managing massive industry funds and retail super funds, you've probably done a reallocation pretty quickly to, look, we better bring some money back to Australia and find a home. Now, at the margin, given the amount of money we're talking, which has to be moved, that's going to have a serious squeeze effect on our market. And for a little while, I think your point is there, like for a little while, the money comes back and it has to be invested and doesn't consider valuation. It just has to be reset in an asset allocation model. So that process could go on a bit longer, especially if the Australian dollar gaps above 70 cents on the back of the stimulus. So there's a lot of issues which are driving market prices, and it's not being, reflected or checked by valuation for the process. So that does take you into a little bit of danger when that happens, but I think there's a lot of money to come home. A lot of money is being directed offshore, but it'll be coming home in the next 6 or so months. So we've got to watch that one.
Yeah, I'm sure you're right there. Another announcement, I guess, relating to our national accounts, the final budget outcome numbers were out, and I saw Jim Chalmers crowing about the second consecutive budget surplus. Do you pay any attention to these FBO numbers, or there's nothing new there, nothing to see?
Well, I think we said about 8 weeks ago it would be the surplus would be upgraded, and in fact that was a leak in the paper. At the time in July, we were talking about a $14 billion surplus, and that was well over 15 billion. So they found another 2 billion since July. I mean, the accounts of Australia, the budgeting accounts are quite bizarre. I read this, that one of the reasons why it was so strong was expenditure was $10 billion below forecast. The forecast they gave us in May, so that's a significant amount of money. I think the other aspect was the surplus occurred even though tax receipts from the household sector or the workers was at a record high. So of tax receipts, workers, a record high since the GST, I should say, went to 52%. They was as low as 48, 47% of total collection was from payroll after the GST. So we're trekking back to very high levels of income tax, Paul, which goes to my point that the indexation or the lack of indexation of tax rates has worked against the population and caused the cost of living crisis to be worse than it should have been if proper tax management was undertaken. Now, the reason we have surpluses is because there was no indexation of tax rates. And now we're indexing tax rates a little bit too late. And we'll see the effect of that. There'll be a small deficit this year. I don't think it'll be 1% of GDP. I think that's overstated. That's a political argument. But I do watch it. And I think the other point was it was a surplus last year. So all this nonsense coming out of the Reserve Bank that the government is spending and causing the inflation problem is not actually supported by the budget of 2024, where expenditure was below receipts. So I just query that a lot of the economic arguments going around about inflation caused by government is actually totally wrong. And what it says to me is the government should have been a lot more aggressive in fighting inflation. I keep on saying it, they've done too little, too late. Inflation's coming down anyway. I'll make this point. I cannot understand the petrol price in Australia. I mean, I drove up to my property on Friday and I was looking at petrol at 170. I drove back on yesterday and it's 190 again. I mean, I don't know who's running the country. But if we want to create inflation, do not put controls over petrol prices. And I make this point. Here we are trying to control retail prices of Coles and Woolworths while the petrol retailers are getting away with absolute robbery. So, I think a little bit more focus across pricing, across non-discretionary expenditure is essential in this country. So I'll just throw that in for what it's worth.
There's another point there, which is that government participation in the overall economy is steadily growing, both in terms of its receipts and its spending. And there were some figures out. So government spending as a proportion of the economy is now approaching some 28%. It used to be sort of 22, 23, 24%. So we're steadily encroaching on. Is that something that you think is unhealthy? I mean, are governments, both at the state and federal level, crowding out the private sector? Is that a problem?
No. It's honest, it's rubbish. I mean, the government has brought in over 1 million people, and we need to have a massive investment in infrastructure upgrades, and that's occurring. Now, the last year's budget didn't indicate that the government was spending 27%. It's a forecast for FY25, which has got everyone in a knot. Now, there is capital investment, and then there's sort of like P&L investment, the budget itself. The off-balance sheet or the off-budget expenditure by government is circa 18 to 20 billion. That's essential asset building, in infrastructure, bridges, roads, upgrades, highways. That's an asset investment, okay? Now, when you invest in, for instance, the Pacific Highway diversion around Coffs Harbour or the other things they're doing around Newcastle, that's an asset of the country, okay? That employs private enterprise. So we employ truck drivers and bulldozers and all of these people who are needed in the infrastructure. So it doesn't crowd it out. It actually employs people to do jobs they're supposed to do, to build infrastructure which the country needs, which will lead to productivity improvements. I think there's too much nonsense being talked about the government overcrowding. Now, where the issue is in terms of government expenditure is the wastage in social services, and it's well documented. We've got a new standard coming in on the NDIS, and some of the things that the taxpayers been paying for NDIS services, I mean, is outrageous. I don't want to go into some of them. I think but that's where the wastage is. It's not in infrastructure development, please.
Yeah, I think that's a fair comment. John, another bit of news which I'm sure you'll find interesting is that Bain is trying to sell 25% of Virgin to the Qatar government and give Qantas a bit more of a run for its money. Do you think that'll happen, and do you think it's a good thing? And will Qantas take a competitive hit, and will Virgin get listed?
Well, Qantas spends a lot of money in Canberra trying to make sure the competition doesn't crop up. it's backfired. I mean, Qantas's brand has been damaged. We've got engineers on strike who rightly look at the salaries paid to senior executives over the last 3 or 4 years and go, well, it's all, why is it okay for them and not for us? You know, look, Qantas's profit is obviously a bit of a work of art in terms of accounting of airlines and leases and all that nonsense. Yeah. But I think it's about time, and it's, you know, I saw a thought bubble come out of one of the Liberal frontbenchers recently and talking about Qantas being asked to divest Jetstar. Well, come in, spinner. I mean, that is very anti-competitive, you know, to have a discount airline owned by a full-service airliner competing in the same market and pretending they're competing on routes. You know, that needs to be thought through, and I think the re-emergence of Virgin as a viable competitor and also engaging in offshore or international routes, you know, through, okay, the Middle East into Europe is a welcome development. And I think it'll be a very brave government treasurer who knocked that one back.
Yeah,
because we're all paying for it, you know. And I'm not against Qantas. We all want a national carrier which is efficient and profitable, but I think there's some question marks over the marketplace which have to be addressed.
John, just to finish up, last week we spoke about the Climb Capital participation plan. Has that concluded? How did it go? Is there still...
There's still time, so any Climb Capital shareholders getting this email, you have till Monday, close of business, to subscribe. The shares are performing nicely, trading above the share purchase price, and investors who subscribe get the next dividend, which is paid in late October, and the yield offered is quite attractive. And we mentioned last week that there is a couple of things happening in the marketplace. Yields are coming down, that's forecast by the bank economists themselves, and the investments in hybrids which was being a very good franking offer for self-directed retirees, that's closing down. Not for a while yet, 5 to 7 years, but you know, Climb Capital yield is attractive compared to a lot of those hybrids in the marketplace. So our job is to maintain dividend, if not grow it, substantially frank it, and maintain and grow capital, and that's what we're going to do. And I think shareholders should look at the offer favourably.
I think we'll end it there, John. Thanks for that, and to everyone out there, thanks for your attention and for listening in, and we'll see you next week.
Thank you.